Good afternoon, everyone. Welcome to our weekly brief discussion around financial wellness. If you've joined us in the past, welcome back. If you're joining for the first time, my name is Matt Dunlap. I'm the AVP of Well Advised K, a team whose mission is to help employers and employees with worksite financial education to help employees be at their best. Each Thursday, we're going to host a brief educational session to help. And for the next 15 minutes, we are going to discuss the basics of investing. We actually have a special guest here today from the Carnegie Investment Council that we'll get to here shortly. But first, we are going to get in with our quote of the day. And this one really is about, it's not about getting it perfect. It's just about getting it going. And we're going to make mistakes along the way, but how do we come back from those and how do we improve from those is really what's important in our resilience, not only in the current things that are going on in the world, but also no matter what stage of life or roadblocks come in our way. So with that being said, I want to introduce our guest speaker for today, Mike Wormer. As I said, he is a registered investment advisor from Carnegie Investment Council with 25 plus years of experience. But I'm going to let him tell you a little bit about himself and Carnegie and then get into the content. So Mike, please take it away.
Thanks, Matt. Good afternoon, everybody. As Matt mentioned, I am a registered investment advisor. We like to call ourselves more as fiduciary advisors, where the difference between a fiduciary is that we act on your behalf when we're working with you, either as a plan sponsor or a participant within the plan. I've been in the business for well over 25 years, mostly in the retirement area, but we also work in the wealth management business. So in today's environment, we've gone through and going through a pandemic, and it's a good time and a good opportunity for you as individuals to really look at where you are relative to your savings and your investment criteria. So one of the things that we like to work with our clients is get a better understanding of what your goals and your missions are. We as a society, we tend to live paycheck to paycheck. As a matter of fact, I'm sure part of some of Matt's programs on the wellness side talks about we're a country that lives paycheck to paycheck. What's that mean is every paycheck we're using to go towards rent, food, utilities, etc. So we're not a society of spending, we're a society of spending, not of savings. Why is that important to you? Is because most people save for really two specific reasons. One is save for potential college education for you or your children. And then secondly, most importantly, is for retirement. Why? It's because in retirement, we're not going to be earning an income. Therefore, we need to have some savings other than Social Security. But what do people, when they're ready to retire, say about how they've saved? And this is an interesting part of it. Nearly 75% have underestimated how much they should be saving presently now is when they're in retirement. They're not saving earlier for retirement because the impact of saving earlier has a huge impact on your account balance. And they have personal regrets of that. And lastly, more than 90% wish they could have talked to their younger self and told them to save more. We all tend to always look back and always say, what could we have done better at a younger age? And one of the things that most people say is, geez, I wish I'd have saved more when I was younger. Therefore, there's a couple things that can impact you. As I mentioned before, we're a society of spending. There is new programs out there that will actually pay you for spending. There's programs called EvoShare will allow you to use a specific credit card if you shop at Walmart or even Target that will give you cash back that you can dedicate towards your retirement plan, but they have to be offered on by your employer. So saving, what impact does savings have? One is, for example, if you're saving roughly around $25 a month and assuming roughly around an 8% interest return on your money, it can impact your account balance in 20 years by $11,391. And if you look down the scale on the left, if you impact your monthly savings by $200, can impact it almost close to $100,000 difference in a 20-year time frame. That's a huge difference about saving on a weekly or monthly basis. Retirement plans are perfectly set up for that. Not only can you save via payroll, But also most company retirement plans today will have some kind of company contribution or matching contribution. Every dollar you put in, the company could match up to a certain threshold. So that's important on the savings side to participate in your company retirement plan. And then the high cost, as I've talked about, is of student loan debt. This seems to be part of the industry today, is the most notable debt that most people have, but actually it's not. It's credit card debt. Therefore, paying off your credit card is usually important. Most people today will use their credit card to buy a lot of things and then only pay off the minimum amount each month to keep their credit card active. This scenario on the right talks about just a credit card balance and how it impacts how you pay it, and the interest factor of well over 18%. And I've seen some credit cards in the 20% range of how that it could impact your total payments over the lifetime. In this case, it's 360 months, can be a total payments of roughly $81,244. So that's the difference between saving and spending. Therefore, a lot of things happen in life. What you need to do is set out a plan and stay on track. You know, most families today don't really sit down and talk about finances. The happier couples discuss money at least once a month. 90% of those are happy if they do discuss what their issues are relative to finances. 68% of unhappy couples don't discuss the finances. Most of the arguments in today's family environment are over finances, whether it be paying for certain items that you do need or certain items that you don't need. This gives you an example. What if, let's say you've been saving for $200 a month in a retirement account and have roughly around $50,000 account balance today. What could happen to your savings in 25 years if you change your monthly savings amount? So for the example, the first one is if you stop contributing to my account, well, if you have $50,000 in 25 years, it will only be about $214,000. If you reduce your savings by $100 a month, so from $200 to $100 a month, it will impact your account balance, and you'll only have $282,000 in that 25-year time frame. If you continue to save the same amount, $200 a month, will be $350. And then if you increase it by as little as $50 a month, which is $12.50 a week, that's $384,489 in that 25-year time frame. So it can go from $214 to $384,000. By statistics today, you should roughly save about 18% of your compensation towards retirement. Now, it can be tough, but that's the ultimate goal, is to get as much as possible savings towards your retirement as soon as possible and as fast as possible. Okay, so once we've spoken quickly about savings, now it's getting into how to invest your money. Well, most retirement plans or IRAs or personal savings gives you multitude of options to choose from, but the most common ones are three types of investments. What we like to call equity, which is stocks, or fixed income is bonds, and then lastly is cash. Part of that, if you are not a sophisticated investor and follow the markets, the easy opportunity is to invest in mutual funds. Mutual funds are a collaboration of different stocks that have different disciplines that will invest in different marketplace. So basically you're hiring a professional in that particular fund to manage it for you. If you like to follow markets and get involved in markets, individual stocks or individual bonds or actually cash is that option. Individual stocks is basically ownership in a particular company. Just a common stock today might be an Amazon, which would be considered a growth stock. But a lot of people don't understand that there are different types of stocks and there's just different types of risk components, and I'll get into that in a moment. But also another area specifically, hasn't had the returns, but it should be part of your portfolio, is fixed income or bonds. Bonds is a guarantee from who you lend money to that they'll pay you back that principal that you gave them and the specific interest of that money that you've loaned to them. Most notable is corporate bonds, but there are also government bonds as well as municipal bonds that you can purchase. But the most common way for folks today that are novice or intermediate investors is participating in mutual funds. One of the drawbacks of saving for retirement is not withdrawing from your money. However, most plans today will have some type of feature in there, whether it be a loan feature or potentially in the COVID-19, there is options now to have what's called a hardship withdrawal component. At the end of the day, one thing is always good, and that is saving, saving, saving. So, but there's really three factors that you need to think about, risk components in your investing. And those simply are longevity risk, inflation, and market risk. So let's talk about a longevity risk. A longevity risk is running out of money. As I mentioned before, you're really saving towards retirement, and assuming you're going to retire at an average age of 65. In some cases, the average will be 67, and some of the younger folks out there is going to be in the 70s eventually. And we're all living longer. So what happens if you do retire at age 65 or 67, or in some cases 62? Well, you're going to have enough money to live on through your lifetime in retirement. So the scale below really shows you the time graphic. If you're a 65-year-old male versus a 65-year-old female, the probability of you living to 80, 85, 90, and 95. As you can see, the women tend to live longer than men. Therefore, they're going to need to have more money available for the longevity that they risk. And as well as the third chart on the right is the probability of one of the two couples living to that specific age. So there's roughly an 88% probability that someone will live to age 80. So it's important that you understand that longevity risk is a big, huge component now, because we are living longer in today's environment due to good medical and taking care of ourselves. Secondly is inflation risk. Why inflation has been relatively tame the last several years, one of the biggest cost factors that we need to think about is in retirement is inflation risk relative to healthcare. Healthcare is extremely volatile these days, and the cost of that, and it's going only one place, and that is up. So therefore, you need to understand in retirement, roughly you're going to need, between you and your spouse, by the time you retire at an average age of 65 or 67, you're going to need at least $250,000 to live, to cover medical expenses that you will have in retirement. So that's going to take up a big percentage of your nest egg in retirement. So you need to factor in that there will be inflation risk, not only in the healthcare industry, but other inflationary risk, which will be other items between food, shelter, etc. And of course, the last thing when you invest in the markets, whether it be stocks or bonds, is market risk. And part of that is, and true understanding is the key to dampen market risk or reduce the volatility is what's called asset allocation or diversification of your portfolio. That would be a combination of not only stocks, bonds, and cash, but also international, emerging markets, etc. That will have a huge impact relative to dampening the risk volatility. The last thing relative to market risk is simply our emphasis, and your emphasis should always be on long term. Never think about the short term. And when I mention long term, at least a minimum of 3 years relative to your decision making relative to where your asset allocation can be. So with that being said, that's kind of a quick overview of investing in the marketplace. Maybe at a future opportunity, Matt will have another session getting into more detail associated with how to get in these particular stocks and how to invest in more in-depth markets other than stocks and bonds. That might be real estate or commodities or other parts of things you can invest in. But most notably, those are the three key components for the markets today. That would be stocks, bonds, and cash.
Well, thank you, Mike.
Yep.
That is, very, very good information for all of our viewers here, and hopefully everybody could take something valuable out of it. There's definitely a lot of content to unfold there that's very valuable in looking, no matter if you're 30 years from retirement or 30 days from retirement, everybody can learn something from that material. So with that being said, we'll be following up with everybody as we always do, and give everybody the availability to contact us with any questions or comments as it relates to this content or any of the other content we have provided on the Well-Advised K Survival Toolkit. Be sure to join us on Mondays for Spark Unplugged at noon from 12 to 12:15. You can enroll for that within the Well-Advised K Survival Toolkit portal. It is led by our mindfulness expert, Julie Fishcorn, who really focuses on all different types of ways to stay at ease during these hard times, really look within to help yourself be more mindfully healthy and limit stress. So with that being said, please reach out to us for any questions, comments, or how we can help. We will be in direct contact with Mike and the team at Carnegie as well. So feel free to contact us, and we can, if you need to talk to Mike or talk to us, we can get you in the right place. So with that being said, thank you everybody for your time. And Mike, thank you for your attendance and participation today in our financial wellness session. We hope to see everybody again next week. But in the meantime, stay safe, stay well, and have a great day. All right, sir. Thank you. That was great. Really well done. And I'll send you the YouTube link and where you can find it if you want to share this with, clients or coworkers, and I'll share that with you once we have it uploaded on our website later today. Sounds good?